Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Here's some more yield curves. We have Italy, Greece, Germany, and the U.S. And the highest yield in this case, it's hard to see, but all the way at the top is the Greek debt, and everybody's been talking about that. So it's interesting to see what happens there. Then we follow Italy, then the U.S., and the German rates are the safest in the world, the lowest in the world. As we move out in time, you'll see that the German rates are the lowest because, again, it's perceived to be a very stable place. The U.S. is very close to those rates. All right, if we go on to the Japanese, the French, the UK, and the United States, what you'll see is the lowest rates here is Japan. Japan has the lowest rates, and then the other three are all pretty much lockstep. The US, the UK, and France all have pretty similar rates. Now, how do option orders affect FX option prices? Well, the one thing you want to know is where the prices are when you start on a certain day, and this is as of a couple weeks ago. Which was the riskiest asset, for good or for bad? Anybody, just if you take a look at this, which currency pair has the greatest potential for growth? Type it in. Which symbol? See who can be the fastest. Which symbol has the highest growth potential? Anybody be able to type this in? It should be somewhat intuitive. And the currencies that I have listed there. Okay, let's see. Somebody just typed it in. Michael, thank you. Brazilian real. And how do we know that? The implied volatility of the option is 16%. Now that 16%, remember I mentioned, is both good and bad. It's 16% up for those of us that are bullish on the Brazilian real. And also, because options actually look to both sides of the market, 16% down. So the Brazilian real against the U.S. should be the most volatile pair. So that's the most volatile. And this is as of January 20th. What's the second most volatile pair? I think this should be, you can take a look at it. What's the second most volatile pair as of January 20th? This should be intuitive. If you take a look at it, thank you, TJ. So there we go. The second most volatile pair is going to be the dollar against the Australian dollar. And then followed by the Japanese yen, and then we have a sort of a dead heat among a lot of others. So when I'm looking at the currency markets each and every day, what am I looking at? Well, I mean, all the other stuff is pretty neat. Yeah, I want to know what's going on in Canada. I want to know. I want to see the euro, definitely. But what I'm really looking at, what am I looking at? I'm looking at the ones that show the greatest potential for movement. And which are they? We just mentioned them. Brazilian real, Australian dollar, Japanese yen. So I want to look at those. And each day I want to, what's the view? Is the dollar safe? If the dollar is safe, well, at least the way the market's been trading, the yen tends to weaken and the dollar will go up. Or also, if the dollar is safe, maybe the dollar is going to rally against the Brazilian real. And we've seen that happen. Today, I think the dollar started off pretty strong over against the Australian dollar. TJ has a question. You usually handle these at the end, but it's very appropriate, TJ, so thanks. Over what period are we measuring? Implied volatility is measuring whatever month we're looking at. So I was looking, I believe these were 60-day options. I should have really noted that. I think they were 60-day. 60-day options. So these were options that were looking out over 2 months' time. So we're not looking at a good point. We're not looking at over a whole year's time. looking out for 2. We could look out over longer, but if you're looking for implied volatility, you're taking the ISE price at that time, and you're solving for what volatility makes that price fair. And I was using 60 days. So very good question, TJ. All right. Options theory. What happens in the real world and in theory, two different things. So in the real world, we might have the red line. This is what some textbook tells us should happen. So that's theory. The red line is the, oops, let me just do that again. Let me just do this again. Red is going to be the theory behind this. So let's just say red. Red is going to be the theory. So red's theory. And what do you think blue is? Blue might be the real world. So blue is going to be what it actually is. So you'll notice that many, many times that the outlying options tend to trade at a little bit higher prices. And that's what's called skew. Skew, option skew. And again, I'd love for all of you to come back when we announce, very soon we're going to announce the option skew class. And I'll show some live vol charts on how they measure skew, why it's important, how it's giving the market expectations for the future. This is really great stuff. Because if you're trading the FX market, whether you're trading the spot market, the futures market, you really want to know what the option skew is, because that helps you understand where the perceived risk is. This is not a holy grail indicator that's going to give you the answer to the marketplace. I don't believe in that. But it will help you be more enlightened to understand which way the market expects a bigger move, up or down, and that helps you. That helps you form your expectations. So if you take a look at this, the blue is showing option skew. The red is more of the theory. The bell-shaped curve ignores these large deviations, although they happen. Now, who would have thought that the Australian dollar would have had such a big move in 2009? So in statistics, highly improbable does not mean impossible. And I love this third bullet. A lot of money is made and lost each and every trading year, because what happens is it occurs in 3 or 4 of the most volatile days. So if we trade 252 days a year, we don't know. I'm being quite frank. I don't know when there's 3, 4 days, 5 days are going to be. But you're going to have some outliers. You're going to have some big days. And those are the days that owning options really helps. And again, if you're selling options, that's going to really hurt. But, you know, a lot of the other days, you might want to be a seller of options. But be careful. Selling options naked can be very, very, very dangerous. Options have value for basically 2 reasons. The cost of carrying the underlying position. I think all of you know this because you guys know about interest rate differentials. There aren't any dividends here. Right? If you're talking about equities, you're talking dividends. You're talking FX options. We are talking strictly about currency differences, interest rate differences, I should say, and volatility. At expiration, all options are going to be worth the big zero or their intrinsic value.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.